Well, welcome everybody. Price Headley, glad to be with you here just after the market close on this Monday, July the 18th, 2022. Your markets popped up off the open and then ended up closing down. So it's one of those markets where we continue to see a lot of whips back and forth as the markets kind of search for a bottom. For a lot of folks, 2022 has been a challenging year as they go back and look at the first half year performance. Here we are mid-July, and now we're getting ready for actually it's been a good year for big trends. So bottom line is that it's an even better time to get started taking advantage of the earnings reports. Everybody thinks and knows in their mind that the earnings reports are not going to be that strong, but yet that's not what matters here. What matters is actually how the stocks react after the lowered expectations. You got to realize there's a big difference between earnings reports, the actual number, and what Wall Street and investors expect going forward. And so that's really the opportunity I see here, is that maybe we've set a pretty low bar with the lowered estimates, and that maybe we get some positive surprises. At the same time, we will get negative surprises. I think you have to be able to trade this strategy I'm going to teach you about today both ways, to the upside and the downside, with different individual stocks that are positioned to either positively or negatively surprise those expectations on earnings. So we're going to get into it and share with you a really simple, but what's been over time effective strategy for us, as I've done a lot of different earnings strategies with options over my 32 plus years of options trading. I'm going to walk you through my favorite one here today. Now, just a reminder as we get into it, that everything that I share with you here today is based on our proprietary research, and it's intended for illustrative purposes only. These should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. So do see our terms of use on our bigtrends.com homepage for more information in this regard. So with that behind us, if you don't know me, I've been trading for, like I said, over 3 decades. Kind of caught the trading bug while I was at Duke University, and once graduating there, became an analyst for a prominent options firm, biggest options newsletter in the country through most of the 90s, and head of research there, and then started BigTrends.com in 1999. And so we've been blessed here now at Big Trends to be on our 23rd year in serving tens of thousands of folks all around the world with innovative and data-driven option strategies. I was very much honored to be inducted into Traders Library's Traders Hall of Fame back in 2007, where they already have a lot of giants in that Hall of Fame. And bottom line is that what I'm think about when I think about that award is that I learned from some true legends in the game who've been in it a lot longer than I have. And my goal for you today is to actually stand on my shoulders as well and learn from decades of my lessons to say, hey, how can we give you a really effective shortcut to the best of the best type of strategies to be more effective in your own trading. Soon after I launched Big Trends, actually less than a year after I launched the company, I was also blessed to be featured in Barron's saying, watch out below, where I don't usually make really dire predictions. I was very bullish throughout most of the 90s, been mostly a bull along the way here and launching Big Trends, but this was definitely a worrisome time in fall of 2000. That was right before, remember, the hanging Chad Bush-Gore election that was disputed, taken all the way to the Supreme Court, and the market started to tank them. But, it was also the popping of the tech bubble. And so you get a lot of people worried about, are we popping yet another bubble? And I believe this is a different time. We're sure we're taking some of the fluff out, but it's not nearly as excessive as it was, in my opinion, back then in the late 90s and early 2000s, where we definitely had a lot more downside in the market compared to what I think we're going to experience this time. So you want to be positioned to not get too negative right now, but actually be positioned to take advantage of some bullish opportunities as we head into the coming weeks, months, and of course into next year. I said this year would be challenging, but I think next year will actually be quite favorable as we get the Fed, worst of the Fed stuff behind us. But I got to appear in Barron's again back in 2002. And why do I go back that far? Because it's kind of what put me on the map for being corrected about a couple of really bad declines that were coming. So really kind of positioning subscribers for what and investors as well as traders, for what's coming, not just in the short term, and the bigger picture is important in it and how you position your portfolio. I believe that the earnings strategy has a definitely a viable place in your portfolio. When you talk about kind of your trading, more active, proactive, we like to call it, piece of your portfolio, where you say, okay, you can buy and hold some of your other long-term blue chip stuff, but if you want to basically give yourself a growth kicker opportunity, earnings gets you a way to get there very quickly, because of course the gap effect of earnings can be very dramatic and very speedy in the terms of overnight. A lot of times we'll put our trades on around 3 o'clock Wall Street time, an hour or so to go before the close, and we'll know either with that night's report or the next morning's report before the open how we're going to do come when stocks open at 9:30 the next morning. So the idea is that, okay, you can't just do this by the seat of your pants. You have to have a systematic approach that will take this whatever edge that you're trying to cultivate in the markets and let you extract that edge over a larger sample of trades. You can't expect that any one trade will necessarily be the big winner. Sometimes the big winners come as a surprise to everybody, but the key is that we take the data edge and basically say, as long as you apply it consistently, you've got a much, much better chance of success over not just a short period of time, but over the longer haul. It's about extracting that edge steadily over time. So that's really where the big trends indicators come in. We're going to share with you two of my favorites that we apply together for this earnings extravaganza service, where we call out at least 20 trades for our subscribers over each primary earnings season. So it gives you an opportunity here over the next month to lock in a bunch of profit opportunities, while we'll help you manage risk as well, because we'll talk about not just when to get in, but we'll always tell you when to get out. We never leave you hanging. That was one of the things that was really important to me when I launched the company back in 1999, is to say, look, we've got to follow through on every trade, whether it was a winner or a loser or a break even. Say, here's what you do to clean it up, take it off the table, move it on to the next opportunity. So we're just really getting into that earnings season launch. We just had JP Morgan, we had, of course, Morgan Stanley, we had Citigroup, and now earlier today, I had like Bank of America, Goldman Sachs. So we've gotten a lot of financials under the belt. And then, but of course, IBM after the close here, you've got, of course, a lot of other ones coming up, Netflix and more. So you want to be able to be positioned to take advantage of the best of the best. I wanted to show you just like a kind of a past snapshot to say, look, this is kind of a quarter by quarter tends to be like where the bulk of our trades tend to fall in each sort of month after the quarter ends, is about where most of the reports come out. So if we just go back to like this time last year, just as in a prior sample, just to give you like a sample of what it can look like. Obviously, past performance never guarantees future results. Some periods will be even better than this. Some periods will be worse than this, but it's about how it plays out over time. But this is actually just over a few days. Last July, we said, okay, in that 4-trade sample, trades close within 48 hours. We assume if you put in no more than $1,000 a trade, in this example, you can see, we had the P&G call. It was the big winner, up 74%, a couple of smaller 22 and 35% winners, and then a 42% loser in AbbVie calls. And we had 3 calls, 1 put. The put actually won. 2 of the 3 calls won, but overall, it was 3 wins and 1 loss. Obviously, that's just one little snapshot, but the idea is that, okay, when you start adding up the wins and losses, looking for us up to a 100% profit target. If we get that, we take it off the table that next day or 2. We won't hold these trades more than 3 days. So we're not going to be in these trades very long, but it's that gap effect that I'm going to talk about, where you get most of the bang for your buck that next morning, for better or worse. Same thing with the downside. We want to keep our downside typically no more than about a 50% give back. So if we can target 100% gain versus a 50% loss, even if we were doing that every other trade, you could add up to a nice little composite return, because your size of your win is bigger than the size of your loss. So the key here is that, okay, you see, it's not something where we expect that you're going to get rich quick off of any one trade, but rather saying, look, on $1,000 invested, if you can double it, sure, you make $1,000. That's great. But knowing that you can lose on certain trades and knowing how this game works is basically saying, okay, now it's about controlling risk, letting the winners run, and if they give them a window, they don't go, then still having a plan to cut them out, move that money back into cash so you can get ready to deploy it into the next trade. You see, we made $669 in gross profit before commissions or subscription fee. Still, that's the bulk of it is what you're hanging on to when you start adding up all those trades that we make over any given earnings season. Now, that's just a small sample, of course, of what's possible. We'll show you a lot of different ways that we take profits, how we cut our risk, what we do to move trades on, but more importantly, right now, I want to get into a little bit more about how you can find these trades on the front end. So our first goal is, okay, we're targeting a double. But then we know that actually if the trade doesn't hit its 100% target that next morning before noontime Eastern, Wall Street time, as we're getting that reaction to the earnings, whether the earnings came out before the market opened tomorrow or even if they came out tonight, the market doesn't get a true chance to react. Sure, you got overnight activity, but we don't mess with overnight action. We say, look, the true 9:30 to 4 o'clock, the reason that's important, the traditional market hours, is because that's when the options trade, okay? Even if you had a view on the stock and the stock's going your direction the night before, well, by the time the options open the next morning, the stock could be even higher, it advanced even more, or it could have flipped on you. So it's important that we kind of tie these into when the options trade from 9:30 to 4 Wall Street time. Now, at noon, though, we change our target. And we say, okay, we gave it a chance at a double. It's not getting there. So we actually adjust from a double target down to a 50% gain. And if we get that, or sometimes it might even be above that by the time we adjust it, but not at a double, we'd say, okay, lock it in at 50% plus. Now, here's a Kroger chart. And you think Kroger is not the wildest name, right? But it can move a lot in short order. KR is the symbol. We call these success stories, and kind of like to document case studies of what worked, and also we'll document when it doesn't. But the idea is that, look, okay, at this point here, we recommended a Kroger March 41.5 strike call. It's kind of an odd strike price. If you're new to options, by the way, I don't want to have to over-explain it if you've traded for a while, but let me have you actually type in excuse me, in the chat box, how long you've been trading options. If you're brand new to options, type a 0 in your chat. If you've traded them 20 years, type the 20. Give me a number about if you're new or more experienced in your options trading to date. So we've got a 2, a 2, a 10, a 3. So far, most of you know what I'm talking about when we talk about options. Of course, a call being a right to buy the stock. So we're just either buying a call, or when you buy a put, you've got a right to sell the stock, which is a bearish bet. So we're just buying typically in the money options here. So in this case, like Kroger was trading closer to $50, maybe actually like $49. It was trading about $7.50 in the money when stock's at 49. And so we pay like $8, $800 a contract to control was already $7.50 intrinsically. So we're only paying about maybe 50 of that $800 as our time risk. So, okay, there's somebody that hadn't traded options, and most of you have 3, 4, 5, 3, and a 0. So the bottom line is that, okay, whether you're new or more experienced, this is effective. Now, what are we looking at here over time? Can add up real nicely for you. Now look, this is the percent R, Larry Williams percent range indicator. This blue line here is what's called the CCI, the Commodity Channel Index, CCI. And you say, well, commodities, we're using individual stocks. I've shown it to work on a lot of the big name stocks when both of these indicators are going overbought, which they both officially went overbought the bar before we got our signal. And then what I want to see is as soon as we go overbought, I don't just buy there. I say that next bar or subsequent bar, it must close above that overbought bar's high to give me what I call the confirmation signal that the institutions are pouring the gas on to these stocks, folks. The institutions, we all know, are driving the market, not you and me as individuals. Whether we trade $10,000 or $1 million, we're small fish in the bigger institutional pond of many billions, right, per institution. So they're saying, look, they want to be on Kroger into this earnings report because we're getting both indicators confirmed bullish. And we're going to show you a lot of examples of this and explain these indicators in more detail too today. But you see, we're getting in there on that circle right here into the close of last hour of the trading day. No, we're not early. You can see the bottom was a few days before. I'm never going to try to catch an exact bottom. I'm never going to expect to catch an exact top. This example where it gapped up, you see that it does go up this next day here. Okay, so that's nice. But by noon, we're not getting our double target, so we adjust, and it was actually a little bit above our 50% target when we changed it. Said let's at least get the 50% gain, and we got 57.5% just after our noon exit alert went out. We send these alerts, by the way, through real-time email to when you become a subscriber to your email address, but also you can get them real-time via text message to your smartphone device, which is so handy, and you get that kind of instantaneous type of a pop-up on your phone that says, yeah, something's happening. I need to buy or I need to get out here, enter or exit. So we'll give you that real clarity and real quick, short and sweet instructions on what you need to do to take advantage of that on the way in, and of course always knowing what to do on the way out as well. In this case, you can see we're a little early. It did carry on a little further. That doesn't matter to me. What matters to me is that we follow the rules of our system. The best trades typically get us there right away, and if they don't, we start adjusting to make sure we're not going to let a profit slip away into a loss, really reduce the risk of that, and also just in general kind of manage our stop losses as well as we go here. So we'll walk you through plenty of examples of this. But that was a tell that the institutional action was saying it's persistent buying coming in. That's what you want to see in front of the earnings news. Most people think that it just comes out of the blue and all of a sudden everybody's rushing to buy right after. I don't know about you, but my experience over 30 plus years of trading and investing is that the institutions tend to know something before you or I do. Okay, so if we can pick that up in the form of not one but both of these indicators telling us that the buying spigot is being turned on and you want to get on that wagon before that earnings gap happens that next morning. So we only place these trades, though, about an hour or so to go right before the earnings event that night or the next morning, so we can be ready to catch that gap as we come into that next morning's trading. So that way you're not left kind of holding and hoping days or weeks in front of the news. You're basically taking advantage of a really fast movement opportunity here. But the other nice thing is fast movement implies, like, would you be day trading? No, we're not day trading because we're in an hour before, making sure you get ready for that next morning's potential gap. It doesn't always happen, of course. Sometimes it goes the other way too. But the idea is that, look, we want you positioned to take advantage of this, and typically exiting that next morning where, okay, it's a 2-day trade, even if you're in one afternoon and out the next morning. It's 2 different days, and therefore it's not any kind of a day trade concern for those that are smaller trading accounts, and we don't ever have day trades in this service. So it's a beautiful thing. Now, the 50% outcome, profit opportunity of 50%, can be fairly common. Let's look at another winning trade example from a couple seasons ago. Just we like to kind of go back and kind of recap the past and say, okay, kind of get ready for now where things are at these days. But this is CVS Health, the pharmacy chain. CVS is the symbol. We are by no means early here. If you were just using the classic percent R and CCI rules to set up when they both went over bought, it doesn't have to happen on the same day, but in this case it did. You can see maybe that's day after it didn't really confirm, but it certainly is confirmed by that second green candle on the 22nd of October. We got in on November 2nd. You say, hey, you're like 7 or 8 days late there, and say no, because sometimes they won't be set up a week or two later after that kind of a signal. They may have already ended that signal. We don't want to take that earnings gap risk. But in this case, we're saying, look, we're willing to wait to know we get the strike price right that we want and say, look where the stock's trading here. It's trading about 91 bucks. You can see what we bought. We bought an 84 strike call. Notice we're buying a November monthly option. We buy the monthly options here, which is the third Friday of the month. We just had the July options go off the board, the July monthlies on Friday. So right now we're very focused on the August monthlies. That's an August 19th expiration. So we're about a month away. In this case, we weren't even quite, but about 2 weeks away. Why would we do that? Because we're buying it so far in the money, about 7 points in the money, and look what we're paying, 7.44. That means for controlling one contract or 100 shares of stock, remember 100 shares here would cost you about $9,100. We're controlling that $9,000 worth of stock for just $744. So you're getting into that neighborhood of about a 13 to 1, 12.5 to 1 leverage ratio. And you see it pops from 91 to 96, about a 5-point pop. And we got, you can see about from $7.50, we ended up getting out just over 11. So we got about maybe 3.75 of that 5 points in the money option. And the beauty of that is, okay, you say, look, at that point, you're, and we were even out a little bit before that maybe peak by the end of the day, right? We're out at noon-ish, or just a hair after noon. Once noon hits, we're changing our targets, getting a new alert out saying, cancel your other orders at a double, get in the new order at a 50% gain, and we lock it down there right after 12 o'clock Eastern. 54.5%. So that works real nicely. Even when we, quote, weren't the earliest on this trade from the original signal. You say, well, why not just trade the original signal from 8 days ago or whatever, almost 2 weeks ago that, in this example? You say, look, the problem with that is that if you're just trading the trend indicator, but you don't know where it's going to be right before the earnings is, it could have already violated. The strike price should change. You'd be doing all these adjustments. We want to keep it really simple and really effective to catch. You can see the biggest part of the move was the next day in this case. So I like to address some common misconceptions, that is, things where people have been trained to think one thing, but maybe that's costing you an opportunity. You've probably done some reading about the downside of if you limit your beliefs. You think you know how things work and you limit your beliefs, and then you actually are missing opportunity. This is especially true when you look at charts, is if you look at charts with certain preconceived notions, you're not going to see certain opportunities. They're going to literally escape your vision because you're not looking for it or you're worried. Like what I'm teaching you about today is an example where I'm saying, look, something's going overbought. We're going to get more in the indicators on percent R and CCI. If stock's going overbought, you've been taught that overbought is bad, right? You've been taught that overbought is dangerous. But actually, overbought is where I've made the best money in my bullish trades, not just with this strategy, but across a variety of big trend strategies that show the institutions are pouring on the gas, and you need to be a part of those strong buying waves from institutions. That's where you get paid the best and potentially the fastest with this very uncommon, unconventional wisdom, I call it. Okay, now, most people think, I shouldn't trade options on earnings moves. That's too risky. And certainly if you buy at the money or out of the money options right into the earnings, yes, you're taking on 100% time risk, 100% risk of a volatility collapse, crushing your at the money or out of the money position if the stock doesn't move at all or moves marginally up or down in your favor or slightly against you. Of course, if it moves way against you, any strategy can be at risk. But the idea is that, look, when we can change the dynamic and say, first kind of solution that we came up with to solve this volatility implosion and time risk implosion off of earnings is don't buy them out of the money, buy them deeper in the money. Also, position size properly, meaning never load your boat, never load your portfolio up with just one trade that you think this thing is just a cinch. It's a practically a guarantee that it's going to do something. Never have that belief in your trading. Always assume that anything can happen, no matter if you've seen a pattern that seems to be repeating consistently. About the time everybody notices kind of an up-down pattern, then you think it's going to happen again, something changes, right? So you want to be able to be flexible, adaptable, and more importantly, not be too overexposed to any one idea, but saying, look, the leverage of options gives you the ability to, even on a smaller position per options trade, to still get great bang for your buck with the leverage of even an in-the-money option that might be 7, 10, up to 15 times leverage against the underlying stock. We don't need 100 times leverage with this strategy. And in fact, we don't want it because we want to make sure we're buying the right type of option, a well in the money option that has what's called a high delta, which makes it move a lot more like the stock. And the more in the money it is, the less you are susceptible to implied volatility changes, which makes you not have to worry so much about how the options are priced for volatility going into an earnings event. So I love this word here. Here's an outlier example. I talk about outliers all the time. There's a great book by Malcolm Gladwell called Outliers. Same guy that wrote The Tipping Point. A lot of other great research. And outliers, the assumption is, well, outliers aren't supposed to happen that often, right? If you look at a classic two standard deviation curve, outliers are supposed to, more than two deviations, outliers happen 5%. Or less is what they're supposed to happen. And you say, but actually, I've seen these outliers happen a lot more often than that. And our system picks up those outlier setups, the ones that can actually give you the opportunity that nobody else is expecting or seeing. I don't know about you, but my experience in 30 plus years of stock and options trading is that when I'm right about trends, I tend to ride and be right about those trends bigger and longer than even I would have expected. And when I'm on the wrong side of the trend, when I'm fighting the trend, or if I, in the old days when I would fight the trend and say, look, that's just a mistake. You're going to have to wait way too long. Time is not on your side, not to mention the trend is not on your side. In options, that's like a double whammy of saying, look, if you've got to not only be fighting a trend, but also be waiting while something's basing out and taking too much time, and all those people that are on the wrong side are still trying to reverse their bets, you're fighting too many waves there. You want to ride with the wave. You don't want to. You don't want to spit in the proverbial wind. You want to say, "Look, let me tune up here and ride the wave, and be in that same direction, not be fighting against it." So outliers, a little eye opener again for things that aren't supposed to be happening, like an overbought market here staying overbought. This was First Solar, FSLR. Again, our first signal setup happens back here several weeks before we actually got into the trade. The setup here took about 4 sessions to finally get the confirmation with the close above that first overbought bars high. So we're in overbought land here, right? And you can also think of it this way, like overbought on percent R is the top 20% of readings, right? You've heard of the 80-20 rule. It's staying overbought as we head into the earnings. We got in on this little red nothing kind of candle here, which means we close a little bit below where we open. You say, isn't that weakening momentum? But the key is that this one been given what we call a retest. I'll put an R by the retest. The retest is when it comes down and tests that 80 percentile level. We were testing right into it, right near $80 on First Solar. It closed that day about 82. We bought the November 75 calls, about 7 points in the money. We paid just under 10 for it, $987. Remember, quoted at 9.87, but times 100 shares for each contract means you paid $987 to buy one option contract that controls 100 shares. So again, 100 shares would cost you like $8,200. This one's only maybe like 8 times leverage against the underlying. That's fine, because look what happens. It goes from 82 up to over 95, and you can see that our $10 option on a 75 strike call, of course, if you paid 10 for it, the easy calculation would be you would need 20, which means you would need to go to 95. In this case, we needed just under 95. You see, we took 99.5% as it hit just under 95, and the option just under $20 the next morning. So and by the way, notice what happens to this the next couple of days. Here we are exiting. If you put an X marks a spot just under 95 here, we're X'd out of that trade that morning, and look what happens. It gives all of that gain back, goes back down to the low 80s over the next 2.5 sessions. So that proactivity is important. So we're guiding you through with the real-time email alerts and text alerts to your smartphone as a Big Trends Earnings Extravaganza subscriber. And we're guiding you through typically about 20 trades over the next month of that earnings season. So we're expecting at least 20 trades over the next 4 to 5 weeks here in our Big Trends Earnings service. So bottom line here is that that's where that proactivity paid off, and also why you take the bird in the hand and you cash it in. You say, well, if it was good news, it gapped up, why didn't it keep going? Because think about it. If you're an institution, you say, okay, I've loaded the boat on this in front of this news event. You've heard the old Wall Street maxim that says, buy the rumor, sell the news, right? That's what's happening. They're buying in front of that news, the rumor, if you will. The assumption is somebody probably knows something, and or some group of people know there's some good news coming out, and you can see as the structure of that trend holds up. In fact, the good news does hit, but then they're saying it's time to ring the register cha-ching and take that money and run and wait for another lower risk entry point. That's one key theme there. Another key theme is that a lot of people think, let's never trade before the earnings. Let's wait until after. But as you see here, wait till after, then the news is hit. Then the risk is that you get to sell the news effect, even on good news. So you can, leave a lot of money on the table based on missing the gap. The gap is the big word here. You know, we've underlined a lot of things, but really gap is what we're playing this strategy for. If you miss that gap, like I showed you on First Solar, and you buy after the gap, not only have you reduced your profit potential buying it a lot higher, but also you've increased your risk. So I contend that your risk reward ratio is dramatically altered against you if you start chasing moves after on an big earnings gap. Sure, sometimes they'll keep going, but other times you see this reversal. And keep that in mind when you go look through more of these charts with me here that I'm going to show you is, okay, think about the danger of waiting till after the gap and watch these charts and say you will leave not only big profit opportunity on the table, but you'll also increase risk. We don't want to do that. So how about an example of a stock that popped hard and then just kind of flattened out? So this is Target. As you know, Target has kind of gone the other way in more recent times, but this is looking backwards and saying, okay, look, this was a bullish trade. We are by no means early. That's why I want to keep highlighting here is that I don't have to be early. You don't have to be early to get paid in an options and a strategy based on earnings and earnings trends here and stock trends. And you can see like this stock had already been on a buy. We actually had a little retest coming in right here off of this low. And you can see I've got my big trends bands in this upper royal blue line. We got the CCI in this middle royal blue line here. It's been on a buy mode above its upper threshold since way back on the left side of this chart. So like we're literally going back almost a month, at least 4 weeks. You're saying, but look what's happening. This is after that one retest, it never retested again. It kind of retested when the day we were buying intraday earlier that morning, but we're getting in here closer to this close and we're buying when the stock's trading in the neighborhood of about 139, we're buying the 130 call, about 9 points in the money. We're only having to pay $967. Now, I know some traders that maybe if you're more speculative in nature, you might say, I never spend almost $10 on an option. I'll buy the $1 options and I'll get 10 of those for that same $1,000 and I'll have 10 times the amount of exposure if I'm right. And I'm like, yes, but you'll have 10 times the risk and you'll be buying the wrong type of option, which if the stock flattens out after the earnings, you'll get cremated on the out of the money options versus you'll be stabilized with this deeper in the money approach. It literally is a game changer and an experience changer, and it's an emotion stabilizer while you're managing yourself and managing your earnings based trades to the ultimate objective of growing your account in a way that you can sleep at night and have a lot less what I call Maalox moments, right? We don't want those stressors. That we want to make trading fun, not stressful. And so managing the risk with the right option strategy is so important. The very next day, you see, of course, what do we need? We needed it to pop about 10 points. It popped even a little more than that, and we got 105% that next morning. And you see, though, again, after that first day pop, where it ran a little bit higher that day, look what happens. It takes 5 days of pause. So sure, if you bought right off the open, you could have made a little bit of money, but again, you would have left this big G here, which is the gap, right? The gap is where most of that profit is in that trade, okay? So that gap there is something where you can't afford to leave that on the table when you've got a clear accumulation from institutions setup that's been happening for weeks in this chart and saying, look, the institutions are riding and buying more. It's almost like they just keep buying almost, I don't want to say irregardless of the price of the stock, but it's like they're building their position. It takes institutions longer than you and I. You and I can get our positions on in minutes, seconds, and for some folks versus institutions, it'll often take days. Okay, so that's why I believe these trends exist. So when you think about all this, you say, okay, then the third misconception is people say, well, technical analysis won't help because really it's about what's happening with the fundamentals, and the fundamentals could be completely different than what's happening on the chart. You could have a great looking chart and then out of the blue the company just reports a total disaster. That's where my contention is, that that's a lot less likely than that the institutions know what's coming on that news and they're buying it up in front of the good news, or we're going to look for a bearish example too, where they're dumping in front of that news, because once by the time that news hits, it's going to be a gap down, watch out below kind of situation. They're dumping it out ahead of that. So of course, EPS is earnings per share, and then revenue numbers are a big factor. There's just way too many examples. I mean, they're countless in my 30 plus years of trading experience, of where you saw what looked like great earnings and the stock goes down the next day. You saw what looked like terrible earnings, the stock goes up. So it's really a function of not just the actual numbers, but how much of that is baked in to the stock price. That's where you might say, well, then if you're buying something that's been on a buy for weeks, and maybe that's baked in. But the idea is that if it gets baked in, then what's going to happen is that stock will start to roll over in front of that news and start selling off. And this is why, market reaction is important to say, look, if it was a flat market and the stock's going up in front of it, that's going to be an even better tell. Or the stock's going up even in a down market, better tell that it's really ready to roll even higher post earnings. Likewise, as you know, it's been a down market in the first half of 2022. Stocks that are going down in front of that news, that's just another confirmation that they're basically matching or lagging the market, is what you want to see in bearish trades. You want to see that relative performance be a tell for you. So here what we're saying is that my research has shown that it's a very specific type of high momentum trading signal. It's got to be in place the day before, in fact, the afternoon before the earnings are coming out, whether the earnings are coming out that night or the next morning, that show me that that trend is in effect. It is active ahead of that earnings news. It's been a very important tell, if you will. It tells me, is this stock positioned to move even more, or is it basically not in a clear buy accumulation or sell distribution mode? If it's a no man's land, I leave it alone. I don't mess. I'm not trading this to guess. I'm trading to say, look, I have an edge. The edge doesn't mean I'll be right all the time. It just means that if you have an edge, you want to steadily apply your capital, not too much at any one, but just steadily over time, to say that you can extract your edge if you don't get too high or too low in your capital allocation. Sonos, S-O-N-O, a maker of like audio devices for home and other use, you can say, okay, kind of tapped into the mobile, Bluetooth revolution, if you will. An example of a stock, it was building momentum for 5 days leading into this past earnings release. And the interesting thing is that while the day before it seemed weak, my indicators say no one day, no one bar or candle makes a trend. It's about the cumulative effect of what's happening here. And so in this example, you can see this. And by the way, this first one here, if you look at this setup back here, it looks like it's setting up right there. But it flips back down here and it doesn't keep going up. So that's an X out. It's a failed setup on that first attempted breakout. So then the next one that happens here, things are starting to go, and then yes, it does keep going, and so we're in a confirmed buy right a few days before, but actually we don't buy until the circle bar here, and you say, well, look, it's giving you like a kind of a doji if you're a candle follower, which means essentially that it closed backward open and it looks like it's kind of lost a little momentum. It's kind of flagging, if you will. But remember, after a breakout, a flag is not necessarily a bearish pattern. It's just kind of a pause that refreshes. So we were getting in when the stock's trading near 17. We were buying the 12.5 strike calls, telling subscribers, hey, get into these. $4.50 in the money. We're paying just under $5. So we're paying just about maybe 11% of the total premium. 10 to 11% of it is time risk. What does that mean? It means that if nothing happens and this thing stayed flat, then you say, look, okay, then we'd be losing the time portion of the trade. The time portion is the portion that's also affected by volatility. The intrinsic value, which in this case was about $4.50 of our almost $5, if it stayed flat at 17, we we can't lose that intrinsic value. It cannot be affected by volatility. That's something a lot of traders don't understand about volatility, right? Implied volatility right in front of earnings. It's only the time portion of the trade that's affected by IV implieds. So you look at this and say, okay, that's a huge move. Obviously, the next day it gets to 22. By the time we don't get to our double in the first few hours of the session at noon, we change the order and we're able to book 75.6% that next day, just after noon, 12 noon Wall Street time. Now, you see, again, while it went up a little higher by the close, look at what happens over the next week and a half. Deadsville, just flat as a pancake. So the gap and that next day's follow through was basically where all the move was, at least from a short term trading perspective. If you're thinking of a 1 to 3 day window, and in this case 2 to 3 day window, based on trading days, then you're saying, okay, that's where you want to be. Take advantage of that gap and that quick follow through. Okay, now you've seen some success stories. Let's go a little bit into a deeper dive on what the indicators actually mean. Williams percent R, Larry Williams developed percent range, commodity channel index. We'll talk about that one too. Not one, but both of these have to be signaling together. If they both are telling me that this stock or whatever rocket is taking off, space shuttle taking off here, you say, look, there's a lot of force being applied to get that launch happening successfully, right? To have a successful rocket launch and shuttle launch, you've got to have a lot of fuel and energy expended to get that rocket from a state of inertia, that is a state of no movement on the ground here on Earth, and saying, look, okay, I've got to really propel this thing forward with a lot of fuel, a lot of momentum. Same thing with buying power from institutions. They're the ones driving the momentum. They can't just be trickling in. They've got to start really pouring on the gas, putting the pedal to the metal, and saying, okay, then we get the true launch effect, where this thing can be a successful launch, not a tiny breakout that fails and crashes back to Earth, right? Don't want those fake outs. We want the true breakouts. So we want both of these to be happening to tell me there's like kind of multiple levels of fuel and power being applied to these breakouts here. And the other point that I show there that I should circle here, of all the points on this chart, this is the one I want to emphasize. They should already be launched before the earnings event. So I've already talked about it, but that concept is, most people think, oh, I'm waiting for something to totally catch everybody by surprise, and it's going to be a huge move. And saying, look, by the time that happens, again, you've left too much of it on the gap on the table. We want that confirmation ahead of that to say that's going to be a higher probability of success. As I mentioned with percent R, percent range, Larry Williams developed this indicator, kind of like an unsmooth stochastic, to say, look, it depends on which thing you look at. You might use a 9-bar, 14-bar, different time frames. And he used a 0 to minus 100 scale. I found that a little bit hard intuitively to get my brain around, so I ended up using more of what I call a grade school scale, 0 to plus 100 from my Big Trends adapted percent R. But percent R implies, like, okay, that there's a range for a stock, right? If you think that there's a stock trading between, say, 100 and 110, okay, so 110 is the top of the range, 100 is the bottom of the range, and I tell you that the stock's trading over here at 109. Okay, well, at 109, that'd be like the 90th percentile, right? If it was at 109. Okay, so, and you said the stock's at 109, should I buy or sell that? If it was truly a trading range here, if I can draw a 9 in there, if it was truly a trading range, you would say, okay, well, that sounds like it's going to come down, right? But what happens is that these stocks don't just stay in the range. They start breaking out through that, and you start seeing these up channels develop. So it almost should be renamed percent T for percent trend, the Big Trends way, because we get them as they're breaking outside of that range, and then they start, as you see on these more and more of these charts, they just stay in that overbought top 20% of readings. It's the classic 80-20 rule at work. The best 20% of your trades are going to drive probably 80% or more of your options trading profits. I'll say that again. Think about that. 2 out of 10 of your trades are going to drive 80% or more of your gains in options trading. As a buyer, it's especially true. And so that means you've got to make sure that you're not cutting yourself short when you've got one of those top 20% of your signals. You got to make sure you get a healthy gain out of that to offset some of the other trades that kind of scratch out or offset some of that gain with the occasional stop losses. But the thinking is that there's beliefs behind every system. Kind of the classic belief in a trading range mentality is that stocks won't stay overbought or oversold for very long. They will eventually revert to the mean. It's called mean reversion. That basically a trading range mentality: buy low, sell high. And what we're saying here is that the trend side is that stocks can remain overbought or oversold for longer periods than you or I would expect. We've all seen it happen more than probably we'd like to admit, where you thought something had gone too far, whether it was the next Tesla, the next Apple, the next Microsoft, or whatever else, and say, look, those stocks can go a lot longer to the upside. Likewise, they can go a lot longer to the downside. That's the Bitcoin folks or the other high growth investors this year, and it's been very bearish environment for the super high growth, high PE names. So anyway, point being that I'm looking for trends here. I'm looking for where they go overbought and stay overbought. I use a longer setting to make that happen. Now, CCI, the Commodity Channel Index, was developed by Donald Lambert at the start of the 1980s. He was looking, of course, at the futures market, thus the name Commodity Channel Index. But I've shown it to work on a lot of growth stocks as well. The reason that CCI's calculation is different and thus more effective to add in here with %R is that CCI measures, Lambert said, don't just measure closes here like moving averages and stuff. Be looking at high plus low plus close, divide those three key inputs by 3, and you get what he called a typical price for that stock for that day. Well, if we close at the high, of course, that means we're going to have like 2 highs and a low divided by 3. You're going to have an upside bias on that particular bar's reading. If you close the low, you have 2 lows and a high divided by 3. It's going to be a downside pull there. So you start adding those up over a number of look-back bars. You start getting kind of a composite trend. Are we closing more near the highs, more near the lows over a given look-back period? That shows you where the momentum is. So, or if there's no momentum, if it's kind of just closing in the middle of a lot of those bars. So the idea is that, look, you want to see everything I've been teaching about here is kind of synced up here, which is that overbought is good. Overbought, going more overbought says we're getting more desire to own that stock. It's pushing it to new highs more regularly, and that you're getting a much stronger CCI bullish reading that way. Oversold tells you that institutional dumping is closing near the lows regularly. They want out. Okay, so that's the philosophy there. Now, another extraordinary example here of what can happen when these indicators come together to meet this very specific criteria. This was Dollar Tree, DLTR, retailer, of course. And you can see this one actually is %R is signaling first. There's our %R setup. I'll put a R by it confirms on that next day's close. So R is confirmed, check. Okay, but you can see CCI comes in on that next bar. So the CCI actually is confirmed check on the next bar. Now they're both confirmed a day before we get in. We get in the next day. Why do we wait till the next afternoon? Because we're waiting for that afternoon before the earnings. This helps determine what our strike price should be. You can see the stock's trading about 87.5. And you can see we're buying a June 80 call. Let's even just say it's at 87. Just for a round number, you say, well, look, at $7 in the money, we're paying $920. 700 of that ish is intrinsic value. A couple hundred of it ish is a time risk. So in this case, maybe more like a quarter of the position is at time risk, give or take. Again, what does 920 have to turn into to double? It's got to turn into 18.4. Add 18.4 to your 80 strike. You're right to buy at 80. Plus 18.4, you're at 98.4. That sounds like a crazy move from 87, right? But actually, it's not crazy. It actually gets up to about 98, 99 right here at the high. We're cashing it in that next morning at our 100% profit. Again, look what happens afterwards. If you bought off the open, the gap up, it may be the first day you're feeling like, hey, I'm making a little bit of money. If you bought the open on this candle chart here, the open is this lower side. The close is up here slightly higher, right? You've made maybe a point if you bought the open, sold the close. We made, what did I just say, like over 10 points, like 11 points from 87 to 98.4 at least, right? So the idea is that, look, why leave that big G, the big gap on the table? And also, why buy there and then get stuck in the sideways to lower, sell the news phenomenon that you see regularly happening after the earnings gap. Now, we talked about the bullish side a lot here so far. I'd like to get into the bear side because let's face it, this year's been more bearish than bullish. That's going to fluctuate, right? But the idea is that if you stay kind of agnostic, that is, you don't get into like, I've always got to be bullish or I've always got to be bearish. If you don't get too high or too low, think you've got to be all one way or all the other, you can stay diversified. And I truly believe, I said it at the start of this year that I thought, seasonally we'd have like a seasonal low in late September when I did my 2022 outlook at the end of last year, where my Big Trends paid members and said, look, you know what, this is something where it's just a typically one of the probably the worst of the times of the 4-year election cycle is the second year of a presidential election term. It's also right before the midterms, right into a midterm election. There's a lot of uncertainty. Wall Street wonders who's going to have control post-November. And I think we're setting up for kind of a really favorable gridlock scenario, hopefully, once we get through the midterms here. And say if that happens, I think Wall Street's going to be very happy and probably will anticipate it even before the early November election result. So the point is, don't be surprised if we still see some downside into that seasonal late September low zone, but also that we'll have bullish opportunities too. So you got to don't get locked into one view or the other, but just say be flexible, be ready to trade both sides. Now let's look at a bearish example. This was Caterpillar. Cat was a dog in this case. It was going down. You can see it was going down well before. This is kind of unusual too, because CCI usually signals at or after %R, but CCI actually signaled here when it broke below that low right there. So put a C on that one, on this close. Okay, then %R set up but didn't quite confirm until it started to break again off of this low, and then %R confirmed that next bar's close right there. So both of them were confirmed a couple days before we get in. We get in, stocks trading closer to 130. We're getting in there right into the close here of that big red candle down there. Okay, so we're not early by any means in this chart, right? It's come down from 155 to 130. Say, I feel like I've missed it, right? Don't think that way. Think, okay, look, we're buying a 137 strike put. If you have a put that you purchase, that means you have a right to sell the stock at that strike price of 137. It's at 130, right? So it's 7 points in the money. We're paying 909. It's a Beatles song in there somewhere. Basically, we're playing the 909. $909 when it's worth $700 intrinsically, so we're paying about $209 of that as time risk, right? Just about, or just under 25% time risk, 75% intrinsic value. It's doubly confirmed to the downside in this case that the institutions are dumping the heck out of this thing in front of the news. And when you think, I've missed it, well, it goes from 130, you see it's down to 115 the next day. What do we need to get our double? 909 had to get to like 18.2. Obviously down at 120, it's 17 points in the money. So like 119, it's 18 points in the money. So just under 119 is what we needed to trade to 115. You say, but you could have made more money, went down below 115 the next day, could have made even more. But if you're greedy like that, then basically you try to squeeze those last few pennies out of a trade, sometimes it can cost you many more dollars. See, by the time it reverses, depending on if you were looking at classic %R and CCI readings, it might have you out by the violation there at 125. We were out at what I just said, just under 119. So that bird in the hand reduces your risk, books the double, takes the money, adds it to your trading account, and you move on to the next opportunity. Okay, buy the rumor, or in this case, sell the rumor, and then cover on the news when you're playing a bearish bet, right? So you can see it doesn't have to be a quote bad stock to make money with puts. In fact, most of the stocks we trade are quality companies that just go through their cycles up and down, right? Even a stock like Apple will drop sometimes. I know it's hard to believe for the Apple fanboys and girls out there, but the bottom line is that, look, here was Apple breaking down. We've got our big trends band up here, which is another way to visualize where %R is starting to break down. And %R is starting to set up back in here, break down there. You can see CCI comes in, needs a little bit more confirmation, closes just under it, not by much, but just barely closes under it, that next bar. So %R, then CCI, the next bar confirmed. And when we're getting in, it's right into what we call a %R retest. That's that test of that black lower big trends band line, which is basically telling us you're in the bottom 20% of readings. Notice what happens. If we're in the bottom 20% of readings, you're below this big trends band black line here. That's where the bulk of the pain is on that oval there that I just circled, is to say, look, okay, when outside that lower band, watch out below. If it's above that upper band, you've got a bullish opportunity potentially. Obviously, right in front of the news, this was bearishly configured. This is back when we were trading a little more aggressive strike prices. We've only paid $5 for it. These days, we'd go more in the money and pay closer to almost $10 for it to say, I'd rather have one contract of it deeper in the money than two contracts of an at the money or near the money option. It's just a completely different risk reward that is much more in your favor as a deeper in the money buyer than as a near the money buyer. Okay, so you might get more leverage sometimes on the near the money options, but you'll take a lot more risk to do it. It's not worth that risk, in my view, from 3 decades of earnings trading experience. Okay, so we caught that over the next couple of days, got the double, took the money and ran. See, it popped up, then it came down to made a slightly lower low there. But again, if you're trying to catch that exact low, don't play that game. It's too hard. It's not where the sweet spot is. The sweet spot is in the middle of the move, not on the ends. It's a lot harder to trade the ends of a move, and it's a lot easier to ride the sweet spot in the middle third of that move, give or take. So as I said, these trades can move a lot more than I expect even. And so the idea is that, okay, we'll take some losses along the way too. But really, it's built into the system, and we manage the risk in our not just our option selection on the front end, but also in our follow-up process to make sure we never leave you hanging. So, and sometimes, hey, because of this, we'll get winners that are even bigger than our 100% profit target. So come in the next morning. Here's an example again. Electronic Arts been on a bull signal for weeks before we got in. This last retest that happened here on %R was right off of that low. See how that low gets tested but never closed below. While it's back into the big trends band, that's a first low is so critical to define. Okay, that's a low that must hold. You see it tested a couple days and then starts to go again, and we're in there right into this close right here last hour, and we bought those 119 calls. They made 140% the next day. See the open there? We're cashing out. That you're saying take it off the table, 140% gain. Notice how it reverses and then again gives it all back over the next 4 days. It's not always going to give it all back, but the idea is that, look, don't take that risk that it could. Take the money and run when you get the double plus. The bird in the hand is well better than the two in the bush, the hope of a bigger gain to come in this sell the news type, exit on the news type of institutional attitude. So we'll get maybe that day of, you can see there was still a stretch intraday here after the gap up, right? But again, we're buying eBay. It's been on a bull signal for more than a week before the earnings. We'd had a retest the day before, still holding up real nice. So we're buying right into that kind of doji-ish, no momentum bar where it would scare a lot of people away and say, this thing's losing momentum. I don't want to trade something that's losing momentum. It's just a pause. It's just kind of catching its breath, waiting for the news. And then you see it goes from 40 up to 45-ish, and our 244 is worth more than 6, and we'd take 166%. So in that case, you see, again, giving it all back over the next week, by the way. No thanks. We don't want to be a part of that. Put a big X through that. You shouldn't be around anymore. You should have said, thank you very much, Mr. Market and Mr. Market Makers. I will take my money and run. This was definitely atypical here on Netflix. This was back when we were probably a lot more aggressive, I would say, willing to buy an out of the money option. So don't expect this to happen. But we happen to make 256% on this trade. I would say just expect when we hit our targets, expect it'll be 100. And if you get more than that, consider it a bonus. Okay, but don't expect triples and quadruples. That's not what we're playing this for. We're playing it for doubles and then looking to control the risk. How do you know which option to trade? I promised you a secret formula in my invite. Here it is. Okay, not holding back here. So what we first do, number one rule, figure out what the weekly straddle is priced at for that particular stock that's about to report earnings. So what does that mean? It means if you look at the nearest the money call and put, and the weekly options are going to expire this Friday for an option for whether you're looking at IBM or looking at anything else that's got earnings this week, you figure out, okay, if the at the money call and put are priced at 5, the stocks say at 100, let's just say $100, and it's priced to add up the call and put premiums, they total up to $5, $500 if you bought the call and the put together. Well, that means it's got to move plus or minus 5% from 100, right, just to break even at the expiration, at least. It's got to move 10% to double that 5 into 10 to go 10 points in the money on one side or the other, right, essentially. And so, but what we do is say, okay, if we had to pay 5, we'd multiply it by 2, and then we would find the monthly option that's priced closely to what that 2 multiplied. In this case, near $10. If we were expecting a 5% move to break even, we would need to pay about $10 to find the one that could potentially double if we catch it on the right side of that move. And so you say, okay, that's how we kind of say, okay, if it was priced at $4, then we would probably be looking for about an $8 option on the side that we want to trade if it's confirmed by our indicators. So that's the option to trade in our view, because the expected move equals about half of the option price.